Picking the best stocks to day trade isn't rocket science. There's actually a formula. And while most traders overcomplicate this, it doesn't matter whether it's large caps, small caps, micro caps, even crypto. If the investment has these 7 traits, you can make money with odds on your side. My name is Tim Sykes. I've been day trading for 25 years. I've made nearly $8 million and I've mentored 50 millionaire students from scratch. Picking the right stock and trading it well is the first step. Here's how I do it. You have to plan ahead. So study other traders who have been successful, study your own trades, weed out the bad trades, focus on the good trades. You have to understand that many traders, many newbies specifically, they don't think about multiple indicators. They only think about one. They're basically like buying a stock because it has good news, or they're buying a stock because it's up. Instead, I want you to think about multiple indicators. So I came up with something I call the Sykes sliding scale. There's 7 key indicators that I add up. And if these 7 indicators add up to a score of 70 to 100, guess what? You have better odds of success. If you actually click the link below, my team and I created a handy calculator so that you can add up these 7 indicators on any trade that you take. And it goes for any kind of stock, any kind of investment at all. Okay, so for me, step number 2 is focusing on these 7 indicators. The first indicator is pattern and price. What is the pattern? Are you dip buying a morning panic? Are you buying your first green day? Or are you just, scalping? Are you just speculating on anything? I have some key setups that I look for. I actually have a video that you should watch on the best setups that I utilize. I try to focus all of my trades on these key patterns. Obviously, you can come up with any pattern you want. If you're a degenerate gambler, you just want to trade. But if you focus on these best setups with the best patterns, with the highest odds, your odds of success on every trade go up. So on the Sykes sliding scale calculator, you can actually rank this kind of pattern based on you, based on your own sweet spot, 1 to 20. For me, again, my sweet spot is stocks between $3 and $5 a share. I like morning panics, morning spikes, first green days. So if a stock fits my sweet spot, I'll rank it a 20. If it's very far from my sweet spot, it's a 1. And you have to try to judge, obviously it's not an exact science, but you have to judge what your own sweet spot is. The higher the ranking, the better. And over time, you'll figure out what you do best on. So the next step in the Sykes sliding scale is risk reward. What is your goal? What is the potential reward versus what is the risk? Ideally, I like stocks where I can make 50 cents to $1 a share. If I'm wrong, I'm going to lose 5 or 10 cents a share. That's 10 to 1. That's excessive. Not every stock is going to be that perfect where you can have that huge upside versus downside. And you have to judge the risk reward based on key technical levels. I don't just come up to 50 cents to $1 a share randomly. I'm looking for, let's say, a technical breakout. If I'm buying a morning spike and the stock high is $4 a share, and I think that it can be a multi-day high or a multi-week breakout from $4 to $5 a share based on the chart pattern. If it doesn't break out, if the breakout fails, I'll lose 5 or 10 cents a share and I'll cut that loss. But on the Sykes sliding scale, you vote this 1 to 20. If it's a 10 to 1 risk reward, that's fantastic. That's ideal. That's a 20. If, let's say, a stock doesn't really move that fast and you just want to try to trade it because maybe you're a degenerate gambler, maybe you're just practicing and you think the stock can rise 5 or 10 cents a share or drop 5 or 10 cents a share, that's 1 to 1 risk reward. That's not good. You want to take trades where there's much greater reward than risk. So if there's only 1 to 1, I would vote that a 1 out of 20. You have to try to avoid those trades. And understand, I know that it sounds complicated to fill out this calculator, but if you're a beginner, you have to think about these indicators before you risk your hard-earned money. So it might be complicated, it might be annoying, but it'll help prevent you from taking bad trades. So use this calculator and thank me later. The next step in this calculator is what is the ease of entry and exit? Some stocks trade with just a penny a share difference. So the bid is at $4.88, the ask is at $4.89, and it's moving every penny. So it's very easy to get in or out of, especially if it's liquid and the stock is trading millions of shares. But some stocks have a very wide spread. Some stocks don't have a lot of liquidity. There are some stocks out there that only trade 50 or 100,000 shares all day. And the spread isn't a penny. It might be 25 cents or 50 cents. So if you buy, let's say, a $5 stock 1,000 shares at $5 and the spread is not just a penny, let's say it's 20 cents a share. If you buy it on the ask at $5 a share and you sell it on the bid at $4.80 a share, 1,000 shares, you've already lost $200. So that's a big slippage cost. What is the ease of entry and exit on every trade? So on this one, I rank it 1 to 10. So if let's say there's a 20 cent or 30 cent a share spread, I would rate that a 1 out of 10. If there's only a 1 cent spread with millions of shares traded, then it's a 10 out of 10. You want to trade the stocks 10 out of 10 or 9 out of 10 because they're easier to get in and out of. So the next step is past performance, history of spiking. Is the company a former runner? It's very easy for former runners to run again because momentum traders remember it. They're more likely to buy it. Short sellers are more likely to avoid it because they remember how far these stocks can run. So former runners can really run. It's very difficult for a stock to just come out of the blue and start spiking with very little or no history of running in the past. So on this step, I vote it 1 to 10. If the stock has run, let's say 100%, 200%, or 500% ideally in the past, I'll be more likely to buy it because then it can respike. Even if it's not necessarily going to spike as much as last time, it's more likely. I would rank that a 10 out of 10. If a company, let's say, has never spiked before, has no history of spiking, I would rank that a 1 out of 10. So obviously there's a big difference between 1 out of 10, but I'm more likely and my trades are more likely to succeed when it's a 10 out of 10. Former runners can run again. Don't forget that. The next step is what time of day is it and what's your personal schedule. This is actually 1 out of 20, which is very important because it doesn't matter if it's the best setup ever, if you're in the middle of a meeting, if you're in a taxi cab, if you're on a flight with little to no Wi-Fi, which by the way, I've traded in all these places, it's very difficult to execute a trade well. So ideally, you have the morning spikes, or guess what? If it's just midday, if it's like 2 p.m. Eastern, that's not a good time. So if it's the right time with the right pattern, I'm going to vote this a 20 out of 20. And if my personal schedule is clear, if it's a random time where it's not necessarily near the market open or near the market close, and there's just any kind of news popping up or any kind of trade popping up, I would rank this a 1 out of 20. And you also have to consider your personal schedule. I know many people don't want to think about this, but we're human. We have lives to live. Some of us like to travel a lot. Some of us are in different time zones. You cannot necessarily make a good trade if your personal schedule is cluttered, if you're not in the right, frame of mind. You might have a headache. You might be sick. I've lost way too much money in the past trading with a fever, trading with like the flu. You don't have to do that. So think about this and really be honest with yourself. That's how you rank this, either 1 all the way up to 20. So the next indicator on my tool is, what is the reason the stock is up? What is the catalyst? Is there an actual news catalyst? If there's an AI press release, if there's a crypto press release, is there a partnership involved? Ideally, a small company being legitimized by a partnership with a big company? Or is the reason that the stock is up just because 2 chat rooms are buying it? 2 very different reasons, right? So I rate this 1 to 10. Solid news catalyst, I'll rate this a 10 out of 10. Bad catalyst, bad reasoning, just chat room, social media hype, 1 out of 10. And obviously, it's not an exact science, so you have to try to judge, but you want to try to buy stocks with the best catalyst. That will increase your odds. And the last indicator is one of the most important. Even though it's rated 1 to 10, it's all about what is the market environment, because 3 out of 4 stocks follow the market at all times. And it's also not just, is the market up? Are the NASDAQ stocks spiking on the day? Is the Dow up? The question is, are there a lot of big percent gainers? It's easier for a stock to spike 200, 300, 400% when there's already a dozen other stocks up to 300, 400%. So even if the NASDAQ is up, let's say 1% or 2% on the day, that's good for the overall market. But how many big spikers are there? If there's only, let's say, 3 or 4 stocks that are up 20, 30% on the day, it's not really an ideal day for big spikers. If you're buying a stock, you have to take that into account. So for example, if there's, let's say, half a dozen stocks up over 100% on the day, I would vote this a 10 out of 10 because that makes it easier for more big spikers. But if there's not that many big percent gainers for whatever reason on that day, maybe the NASDAQ is down 1% on the day, or the markets are down, or maybe there's some bad negative geopolitical news, then I would vote this a 1 out of 10. So again, you have to be very honest with yourself. Can the stock that you're looking at or any investment that you're looking at really spike big? Is based on the market that influences things. So adding up all of these indicators, you will get a total score of the proposed investment. It will add up between 7, if all of the indicators are ranked 1, all the way up to 100. If the total value is over 70, that increases your odds of success. Obviously, the higher, the better, because all of your indicators are heading in the right direction. But I can't tell you how many people have been saved by this tool because for whatever reason, the total value adds up to less than 70. If it adds up to 50 or 40 or 30 or even 20, stay away from risking your hard-earned money. You want these indicators heading in your favor. Anything can happen on any stock, but you can control your preparation. And I know it might take time to fill out this calculator, but guess what? It gets easier over time. I can do all of this in my head, so too can my top students. In the beginning though, it's good to list out all of these indicators. It'll help prevent you from taking bad trades. So I really encourage you to use the tool linked below in the description. Use this on every single trade or proposed trade that you're looking at. That will only increase your odds of success. You're welcome. So I'm going to be doing a part 2 using this tool in real time along with in-depth technical analysis. So be sure to subscribe and turn on your notifications and study up.